Every financial screen on the planet is flashing green right now. And I need you to pause before you do a single thing with your silver position. Oil is sliding. Bitcoin just cleared a level it hasn't touched in months. The NASDAQ is printing a new all-time high. The S&P is doing the same. Risk assets are in full celebration mode, and the narrative driving all of it is a single word: peace. But here's what I want you to understand before this video goes another 30 seconds. I am not looking at the headlines right now. I am looking at the vault reports. I am looking at the physical delivery figures. And I am looking at a framework document that, as of this recording, carries 0 binding signatures. This is OG Peter with SilverDispatch, and what I'm going to walk you through today is the complete picture. Not just the part the algorithms are reacting to, but every layer underneath it that determines where silver, oil, and the broader commodity complex actually go from here. Before I get into the data, drop a comment right now. Tell me what you currently hold. Tell me where you are watching from. The figures I am referencing are current as of the time of this recording. When you watch this video, whether it's today or next week, post the live silver and oil prices in the comments. That turns this video into a real-time reference point for every viewer who finds it going forward. That is how SilverDispatch builds something with lasting analytical value. Now let me give you the full sequence of what actually happened in the exact order it matters. This morning, Axios published a report sourced from 2 U.S. government officials and 2 individuals directly briefed on the negotiation process. According to that report, the White House believes it is approaching finalization of a 1-page, 14-point memorandum of understanding with Iran. The negotiation involves U.S. envoys Steve Witkoff and Jared Kushner on the American side. The U.S. side expects an Iranian response on several unresolved key points within 48 hours. Critically, Axios included a specific caution in the same report. Nothing has been agreed yet. This is the closest the 2 parties have come to a formal agreement since the conflict began 67 days ago. But proximity to a deal is not a deal. The reported framework includes Iran committing to a moratorium on nuclear enrichment, accepting UN inspection protocols, and limiting underground nuclear activity. In exchange, the United States would ease existing sanctions and release frozen Iranian assets. Both sides would also ease restrictions on transit through the Strait of Hormuz, though the precise conditions of that opening would be determined through a 30-day negotiation period following any signing of the memo itself. The market did not wait for signatures. It priced the best possible outcome immediately. This is where it gets interesting, because what the algorithms priced and what the Axios report actually says are 2 fundamentally different things. Let me give you the price action first, because the numbers themselves are telling a story. Brent crude dropped below $96. Just days ago, it was trading above $120. That is a collapse of more than $30 in under 2 weeks, almost entirely driven by the escalating peace narrative in financial media. For context, when the 2-week ceasefire was announced back on April 8th, Brent fell roughly 13% in a single session. Today's trajectory is following the same structural pattern, only faster. Bitcoin reached $82,000. That represents a gain of approximately 30% since the conflict began 67 days ago. $50 million in short positions were liquidated in 30 minutes as the price broke through resistance levels that had held since January. However, and this is critical context, Bitcoin's actual all-time high was set in October 2025 at $126,980. The current $82,000 level sits nearly 37% below that peak. The crypto market is executing a peace trade. It is not signaling a recovery to all-time highs. NASDAQ futures hit 28,344, a record. S&P 500 futures printed 7,350, also a record. Gold surged above $4,700. Every risk asset class simultaneously priced an outcome that does not yet legally or structurally exist. This is where analytical discipline separates long-term holders from people who get shaken out of structurally sound positions by short-term narrative swings. The Axios report contains 4 specific words that every algorithm apparently skipped over. Nothing has been agreed yet. Let me show you exactly what the market is missing. The memorandum, as described, is a framework for 30 days of further negotiation, not an agreement. Iran has 48 hours to respond to several key points, which by definition means there are key points that remain unresolved. The Strait of Hormuz opening, the single most important supply-side variable for oil markets, is explicitly contingent on detailed negotiations that would take place after the memo is signed, not as a precondition of signing it. The open is not guaranteed by the memo. The memo only guarantees that both parties commit to 30 days of discussions about the conditions under which the Hormuz would open. That gap between what the market has priced and what the document actually commits to is precisely where every silver, gold, and energy position for the next 48 hours lives. This is not a subtle distinction. It is the entire trade. There are exactly 3 paths forward from here, and I want you to understand all 3 before any of them play out. Because the next 48 hours decide which one we are in. Scenario 1. Iran responds within the 48-hour window and accepts the core terms. The memo is signed. A formal end-of-conflict declaration is issued. In this path, the market receives confirmation of what it has already priced. Oil likely stabilizes near $95 to $96 because the market now waits for the actual Hormuz opening, which requires the 30-day negotiation to conclude successfully. The war risk premium that pushed oil above $120 has largely unwound. For silver, this scenario removes the geopolitical overlay and leaves the structural story, the physical deficit, the vault drain, the accumulation patterns from China and Turkey, as the primary driver. Silver consolidates while the market reassesses what fair value looks like without a war premium, and then the structural supply deficit reasserts itself. Scenario 2. Iran does not respond within 48 hours, requests modifications, or rejects key points. The 14-point framework stalls. Every asset that rallied today reverses. The war risk premium returns to oil immediately. Silver recovers the geopolitical bid it gave up in the paper market flush earlier this week. Bitcoin retreats from 82,000. The NASDAQ, all-time high, becomes a distribution trap for anyone who chased it this morning. This is not a low-probability outcome. Iran's Parliament Security Committee has already stated publicly that U.S. naval presence in the Strait constitutes a ceasefire violation. Iran has consistently demanded U.S. troop withdrawal from the region as a prerequisite for any comprehensive agreement. Neither of those demands is addressed in the 14-point framework as reported by Axios. Scenario 3. The memo is signed, but the 30-day Hormuz negotiation fails to produce a workable framework. Both parties return to a standoff after 30 days. This is the delayed version of Scenario 2. Markets get 30 days of relief, and then face the same structural problem. Oil reprices the risk premium back in. Silver reprices the risk premium back in. The physical delivery data continues throughout all of this regardless of which scenario plays out, because the people standing for physical delivery have a thesis that is completely immune to 48-hour news cycles. Now let me tell you exactly what I'm watching in the next 48 hours. First, the Iranian response timeline. If Iran responds within 24 hours with acceptance of the core terms, the risk-on move extends. If Iran goes silent past the 48-hour window or requests modifications, Scenario 2 becomes the base case. Watch the Iranian Foreign Ministry and the Supreme National Security Council. Those are the 2 bodies with actual signing authority, not the Parliament Security Committee. Second, the oil price level at $95. If Brent cannot break below that floor and hold there despite the full weight of today's peace narrative, it signals a physical market floor independent of headline risk. Third, the COMEX Daily Warehouse Report. As of May 4th, the registered silver pool stood at 79.6 million ounces. The May delivery cycle has already seen 23.9 million ounces demanded and delivered. That vault drain has not paused once during the 67 days of this conflict. Not during the April ceasefire, not during the escalations, not today. Go back to April 8th. The market did exactly what it is doing today, and the people who reacted to the narrative paid for that reaction twice. When the 2-week ceasefire was announced on April 8th, Brent crude fell 13% in a single session. The market celebrated. But here is what actually happened. The Hormuz did not reopen. The ceasefire held in name only while the physical blockade remained in place. 2 weeks later, the ceasefire expired without a comprehensive agreement, and the oil risk premium partially rebuilt. Every trader who sold their position into that peace rally and then bought back 2 weeks later paid twice in commissions and spread for the position they never should have exited. Today's structure is identical. The Axios report is credible. The 14-point framework is real. But the market is pricing an outcome, not a process. And this particular process has 7 distinct points at which it can stall, yet the market is pricing the single path in which all 7 resolve sequentially without a single breakdown. However, there is a 4th indicator I want you to track alongside the 3 I already gave you, because it is the most telling of all. Watch where silver closes today relative to where it opened this week. Silver came into this week under pressure from Monday's risk-off move. It moved higher today on dollar weakness and physical demand. If it closes strong today, despite the peace narrative that is actively pushing oil lower, that tells you the silver bid is structural, not a geopolitical trade. A strong silver close on a day when the official war risk narrative is in decline is the clearest signal available that this market has a demand floor completely independent of the headline cycle. Now I want to address something directly, because this question is coming. Once silver reaches a meaningfully higher price level, a large number of people are going to ask whether they missed it. They will look at the price chart and see how far it has moved. They will not look at the deficit data. They will not look at the vault drain figures. They will not look at the 762 million ounces consumed since 2021 that cannot be replaced by current mining supply. They will not look at Turkey importing nearly a third of an annual import total in a single January, or China recording its largest monthly silver import figure in documented history this past March. They will simply see a price that is higher than when they first heard about it, and they will conclude they are too late. You are watching this video because you understood the structural argument before the price reflected it. That is the only edge that actually matters in any commodity market. The people who will ask whether it is too late are the people who are about to discover what the physical delivery data was signaling during all the months when the paper price was being pressed lower. Everything on SilverDispatch is free, publicly sourced, and verifiable. If you see any account using my name or my content to run paid groups or trading signals, report it. That is not me. Check every number I give you independently. That is the standard here, and it is non-negotiable. Hit the like button if the 3-scenario framework gave you a structured way to hold your position through the noise of the next 48 hours. Subscribe with the bell on so you get the follow-up the moment the Iranian response comes in. Drop the current silver and oil price in the comments when you watch this.